Hey everyone, this is the 17th of January 2016. We've seen 2 weeks of a lot of market selling, and it's come on the back of a lot of news related to global events, but also a bit due to the domestic events. But I think the highlight was really the global events, at least if you looked at what the news was all about and all the panic around world markets. But a lot of these trends which were seen as the cause, and that's what I wrote last week, whether it's the rising dollar, falling commodities, falling emerging markets, the China problem, all of them looked a little out of whack because these are trends that were developing all of last year. I've been writing about them since 2014, that the dollar index was headed to 100. Commodities were falling. We had targets of the crude dropping all the way from 100 to 70 and then to 60 and 45 and so on. And so I posted a chart today where I've shown the correlation of the Dow to crude, and the downward correlation was essentially not when it fell from 100 all the way to 45, then it bounced back to 60, and then when it started falling again between 52 and 30 52 and $38, that's right, is where you saw the Dow fall along with crude, and then it bounced back, everything bounced back, and again it looked normal. Crude started to fall again. The US market did not react. There was some volatility, but the big reaction in the last 2 weeks came essentially between 38 and 29. So it's only in the final moves that it appears, oh, there's panic, and in the rest of the moves things appear to tend to hold on, waiting for hoping for that things seem to be normal. In fact, a large part of the decline, like I said, from 100 all the way to 45, the US market was actually up for that year most of the months. So the point is that the panic is coming in the final stages of these moves, and so you wonder whether it's the start or the end of something. So that's one angle to it, but of course these are problems that you deal with ahead, and maybe the reasons are something else, and that's what I believe. I think the media is always looking for a reason, and so the easiest reasons to find were trends of the past. So they're just talking about something that happened yesterday, or rather that happened all of last year, and extrapolating into what is going on right now, but that might really not be the case. And the same is with China. The Chinese stock market was in a bear market from 2009 to 2014. Nobody worried about it. It had its biggest rally in 2015, and then when it corrects and now it's higher than where it was a year ago, the whole world wants to worry about it just because margin funding is stuck up. Is it that, or is it something else? And there was an interesting argument, and it came, it's been moving around. You may say they are rumors, I don't know if they are real, but essentially that, funds that are stuck with, oil positions, or funds that are stuck in China, and they are actually selling positions everywhere else to actually make up for those losses. Now, it's a logical argument. It really needs to be looked into, but at least it sounds like more sensible than saying, oh well, now the market is falling because of oil. I mean, that doesn't make sense. So something is definitely happening out there, but a lot of what is being reported doesn't actually make sense. So those are don't appear like the right reasons. Those reasons were there at that time when I was looking at them, and they were bearish. I've put out so many notes on so many global currencies to fall, and they've all happened. And a lot of them are in fifth waves of some degree. In fact, we've already seen the IDR, the Indonesian rupee, which was so much of a panic mode, corrected sharply a couple of months back and is far below its highest level. Whereas maybe the Canadian dollar is in a fifth wave at the upper end of a channel. RSI is like 90. And I don't know, is it now that you want to worry about it? So these are trends that have been going on, and they are worries of the past that are being looked at as reasons for what is going on right now. But what might have happened just right now may be due to completely different reasons. So what would be these different reasons? I think one of them, which is now in the press, at least in the last 2 days, is around the banking sector, and that's where we saw the biggest losses recently. There was an economic note I was going to, I was writing some time back about what to expect in the economy in the coming year, because I hadn't written a economic update since a long time, not even the update article. So, and then later since I didn't publish that because the markets were down and they were bouncing back in October, we decided to actually go into and look at all the other data which I published in the detailed report, the original Kondratieff article, and I said, let me write a complete update, a new article that goes over the data points which are related to the winter cycle, which is essentially debt, because when you say you're in the Kondratieff winter cycle, then it's all about debt. I started writing that in 2010, so it's not new. And I think in terms of the view, it is definitely played out because after 2010, most stocks that were indebted actually did very poorly. They all fell for years to go, still falling now. The market, of course, did well because of all the inflation that we created to actually reduce some of that debt. And once again, those problems are coming to the fore because, like I've been saying, the winter cycle is not over simply because we've not dealt with the debt. Now, most people would say, oh, what are you talking about? This is all the US problem. It's not India's problem. But that's what I've been saying. It is India's problem. In 2009, most people thought no. A couple of people did see the trouble, at least in the capital goods sector. It's only now that it is getting accepted as a problem of our own banking. Of course, we saw PSU banks get hammered most of the last 2 years, so most people said, oh, that's a problem of only public sector banks, and I've disagreed with that. It's a problem of the banking sector. And more recently, I was hearing a big investor argument that, yeah, it's a problem of the banking sector and there's only one good bank in India. Well, if that was the case and it's not being made out in the reports that are published, then essentially you're saying it's the whole banking sector. I mean, one bank that doesn't make up the entire sector. And the reason to say this, it's not about banks itself, it's about the debt in general. So let me just highlight some of the outcomes of my more recent study and some of the studies that are been around recently on emerging markets as well. The combination of them shows one particular trend, and that is, as far as India is concerned, our debt to GDP ratio has actually been going up year after year. And currently my estimate is it's closer to 150%. Some reports, economic reports, say 120, 130. But the government itself 3 years ago published 135, so that was closer to my number. All of that is taken from RBI data on their sites and all nominal GDP numbers to calculate this. So we just updated those, and the number came closer to 142, and I'm saying it's closer to 150 if you just presume that there are some invisibles in terms of what you wouldn't add. There may be small numbers, NBFCs, cooperative sector, fixed deposits of corporates and so on, a lot of other numbers that you wouldn't really add up in the generally disclosed numbers, which is total bank credit and the government debt numbers which are published by the government, finance ministry and RBI. So essentially the trend there is that the government debt was actually at 90% way back in 2002. The government debt was actually at around 90%, and the reason for that was they were actually spending more money to boost the economy at that point of time. And over the years, as the economy actually turned around, the debt to GDP ratio actually started to come down for the government. In fact, it was down to around 70 to 73% when the Congress was already in power, and now that number is down to around 60 to 61% for this year. So that's a huge reduction. It's been happening year after year, one on the part of growth, second on the part because you've had inflation, which also inflates nominal GDP, so your ratio actually keeps coming down. And of course, if you've read all along for the whole decade, the government has been focused on keeping fiscal deficit under control, and that typically means that your debt is growing at a lower pace than your nominal GDP is, and so their ratio has been coming down all this while, which gives the government a lot of room to really boost the economy when it wants through spending. The only problem is that they don't have the mandate, at least now, to inflate, because the general public vote is against inflation. So you'll have to get to the point where the general public vote is fine, you just get growth going, we don't care about inflation, and at that point I guess they'll step in and spend more. But till that point, what has happened is that because the government has been pulling back on its debt, it hasn't really slowed down the total debt to GDP ratio, which is, like I said, it's gone up to 150%, and that's the real story. The real story is that private borrowing and corporate debt has actually been going up throughout this time period. So if I just remove 60% from that number, it means the number would be closer to around 90% for the corporate sector. A lot of that has also now started to come from the external side, which means, I mean, you have external debt which is some $300 billion over 300 billion. And this is not just an India story, because total emerging market debt and borrowings over the last 5 years or 6 years since the Great Depression or the Great Crisis of the US, or as they say, the Great Recession. Since then, a lot of the slowdown led to borrowing, and that borrowing has essentially created a lot of emerging market debt running into the trillions, and that's the big thing that global investors are really worrying about with all these currency crises. How would these debts get repaid? Now, of course, on a relative scale, we can say India's debt to GDP at 150%, much less than US is at 330. But remember, it was at 370 to 360 to 380%, in that range for the US in 2008, almost reaching 380% at one point, if I'm not wrong. And it's down to 330. So they've actually, through all the money printing, also managed to bring down their own total credit market debt number. So that was an interesting data point that I saw. And at the same time, but those numbers are high, and we know the numbers are the highest for probably Japan, and they're high for most of Europe. And in that sense, you can say, where we are relatively less. But if you compare this to any previous time period, even maybe the 30s, this number is not that less. It's already into trouble territory. Just because it's less than someone else who's in trouble doesn't make you less out of trouble. And the essence is that at this point, what you're finding is, no matter what you do, you're not able to grow. So even though GDP growth is actually showing up, earnings growth is not happening. And this has all got to do with the cost of debt, which is underlying in the system. So you have to solve this problem. You can try to inflate and keep growing, but we are not the United States. We don't have the reserve currency of the world. We do not consume from the rest of the world by paying in dollars. So we cannot do exactly what the US did. And therefore, any spending plan that we take or undertake ends up being either inflationary or ends up, having an impact on our currency. So directly or indirectly ends up creating trouble. So that's the real issue. And if that is the real issue, where all the debt is held. It's essentially held in banks, and at some point it had to show up as a banking crisis, whether public sector or private sector. And that's really the end game and end of winter that you would really expect. The winter cycle, the economic winter for India, ends when you've dealt with that debt, when you've had the banking credit problems resolved. The number is already somewhere between 2 lakh to 3 lakh crores, something in that range required in terms of funding for public sector banks. I'm sure there'll be a funding requirement for private sector banks as well. And when all of that is done, you've done the balance sheet cleaning and recapitalization, is when I think this bear cycle truly ends, and you can have a more serious, meaningful bull market in India. So that's been the broad view, and I guess if I said this 3 years ago, it would sound out of whack, and it probably did when I first started writing the Kondratieff articles. But right now it probably sounds like, oh yeah, that's what is going on, because it's become well accepted. And the most recent event was RBI actually pushing it down. I thought probably into the bear market this would just tend to happen, but RBI is actually pushing for it, asking banks to report and start taking action as far as their NPAs are concerned. So that really brings the banking crisis into the fore, rather than something that would have just happened with the weakening economy. So that's going to speed things up, which means that my expected timeline for this to end by end of 2016 is actually looking like more feasible now. And yes, that also means that the so-called Kondratieff cycle theory is not a bunch of garbage. It's for real, because it seems to at least played out in every respect as far as India is concerned. The only reason it gets discarded is essentially because it was originally considered a time cycle, something that occurs in a fixed period of time, because previous cycles were 40 to 50 years. And as I've written in my previous notes, that it's not a time cycle, it's essentially a cycle of events that flow one after the other. And the reason these events are taking longer is, one, you can say that we have a lot more financial innovation, but the really logical reason would be that the life cycle, or lifespan of man has actually expanded because of medical progress, and the demographic cycle essentially, which has to do with how long you live and what you do at each stage of your cycle, essentially helps in extending or contracting this cycle. So I guess the shorter lifespans led to the cycle being a 50-year, 60-year cycle, and the longer lifespans now today lead the cycle to become even longer and more extended. So I think that's the broader logic that you can apply to why that tends to happen, but that doesn't change the fact that these are the events that they have to be taken care of. The solving of your debt cycle is essentially what a winter is all about, whether you do it one way or the other, and then it gets followed by spring. So the good news for India is we are getting closer to the end of this cycle. It started in 2010 and probably ends by 2016-17, and then we get a really much better period ahead. So that's all in this update, and thank you.